Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm really thrilled to have a repeat guest on the show with me today, Ray Mhere from Prescient Investment Management. He's head of retail there. Ray, thanks so much for joining us.
Hello, Warren, and hello from a sunny Cape Town.
So, Ray, we're kind of exposing ourselves to our listeners again to kind of get their questions. So, I appreciate you coming on board and sharing your insights with us to kind of help our listeners navigate this world of money. So, I think without further ado, let's kick off the listener's question.
Hi, Warren and Ray. I have a question about ETFs. How do they work and how does a share work? What is the difference between an ETF and the difference between a share? And how do you accurately read the stock graphs on Easy Equities or any other stock market website? You often get a 1 month, 3 month, 6 month, 1 year, and max view of the graphs. I want to know which one I should be looking at before I invest in a holding company or an individual ETF or share. Thanks so much.
Wow. Okay, that's there is quite a bit there to talk about, Ray. So do you want to take the first shot?
Yeah. Let me start with, before we get to the kind of how to read graphs and kind of returns and all of that, let me start with the difference between ETFs and shares, and I might even throw unit trusts in there as well, just for comparison's sake. So a share is a company in South Africa that lists its assets, its stock on the stock market so that the individuals like you and I can become owners of that share. And that's their way of, I suppose, raising capital within the market and giving you a share of their business. And in return, you get the growth of the share price and you get dividends from their earnings and profit. Now, over the years, I think the financial services industry has come up with what we call ETFs. These are exchange traded funds, and these are pooled kind of investment vehicles that allow individuals to invest in either shares, companies, or commodities, or a group of any kind of property or anything. And I suppose the underlying, and they call that kind of that grouping an index, which allows you to kind of diversify. Instead of buying one share, you can buy a grouping of shares that are similar. And these days you can do all sorts of amazing things with these ETFs. I mean, you can buy value ETFs, which kind of look for shares that are undervalued. You can buy momentum that kind of look for shares that are going upwards, hopefully. So what you get in an ETF is you get the money gets put into a pooled vehicle, which allows you to kind of diversify your risk as opposed to buying one share, and you're buying a group of shares within that ETF. Very similar to a unit trust, which is also a pooled vehicle that buys a lot of underlying things to kind of diversify your risk instead of buying just one thing. There are some differences between the two, some of them being that the ETFs are generally available on kind of stock trading platforms or stock broking platforms. They are starting to get available on unit trust platforms, whereas unit trust platforms aren't available on stock broking platforms. The pricing is slightly different between the two, in the sense that when you're buying on an ETF, you're buying it on a stock market like you buy shares, and there are certain stock broking costs that go into that. And then on a unit trust, you pay platform fees if you're buying it from a platform, or you're buying it directly from an asset manager and pay an ongoing asset management fee, whereas with an ETF you wouldn't pay an ongoing kind of fee. Again, things that you'd have to compare, and at times you might even find a unit trust and an ETF that invest in the same underlying companies or indexes.
Yeah, I think that's a very comprehensive response. So to me, it's maybe those are the differences, and then the why. You know, why do you buy the one or the other? And I think, to me, an exchange traded fund is very valuable when you just want the most generic index exposure. In other words, you say, look, I want to invest overseas and I just want to buy the entire world stock market. I think it's quite hard to find something better suited to that than an exchange traded fund. Especially if it's a good index provider, the costs are going to be low. It's going to be well distributed, and lots of information will be available on that. But if you're saying, I want to try and get a better return than the stock market, then your options increase substantially, and I think then you need to do a lot more homework. And then your two main routes, as far as I'm concerned, will either be a unit trust or a collection of individual shares. As a way to try and get that return, and I think we've spoken about it on Honest Money in the past. I think the world's too kind of polarized and too kind of it's one or it's zero, it's A or it's B. You're Republican or you're Democrat, and I think that actually in the world of money you need to be very careful to be too absolute. I think you need to say that actually there'll be times when when paying a unit trust manager or buying individual shares will be rewarding, compared to buying an index. But there'll be other times when the index will be more rewarding. And the reality is, having a combination might be a very good outcome there. So I think that's it's important that when you're listening to this and you're asking us about the differences, those are the differences. But the why you're buying these things is really important, because you need to be very clear in your own mind as to what's going on. The fact that there are thousands of exchange-traded funds and there are thousands of unit trusts doesn't mean you need to buy all of them. And certainly when there are new ones being issued all the time, equally, it doesn't mean that you now need to become a buyer of everything that's new and exciting. Because sometimes new and exciting is a great way to lose money and just have a story to tell, and very, very expensive story. And I think, maybe just on that point, we need to also just be really careful now, because the exchange-traded fund world is becoming increasingly complicated. So what you're finding now is more and more companies want to get in on the exchange-traded fund market, and so they're trying to kind of create new, different, exchange-traded funds that are not following just generic indices. And sometimes those exchange-traded funds are super expensive and not that transparent. And that's a real concern for me. So if you're in that space, it might, and you're looking for something that's fancy and exciting, be careful that you pay too much money into an exchange traded fund. And to Ray's point, when you buy an exchange traded fund, sometimes they trade all the time. They trade live on the stock exchange, but sometimes they need a market maker who will, if you want to be a buyer, they will sell you the exchange traded fund, and if you want to sell it, they need to sometimes buy it back from you. And there is a hidden cost that can be allocated to you, because that difference between the buying and the selling price can be quite wide in the exchange-traded fund market, even though it trades on the stock exchange. So I think just be careful once you go out of the big generic indices into kind of these more kind of niche products. They're not necessarily as cost-effective as you think. So I mean, I think I can't add much to your kind of explanation. I think it was very good, but I just think the key point here is the why. Why are you buying this? Be very clear as an investor why you're owning it, what you want to do, and it can't be simply to chase last week or last month's best performer. Because that's really dangerous. I saw lots of exchange traded fund providers punting fourth generation or fourth industrial revolution, or whatever it is, the crypto greatest hits, ETF and all of those things, they relate to an investment fashion, and most of the time they're getting promoted to you once the fashion is passed. And that's not, that for me is a great way to lose money. And I think just be careful there. So that's my kind of cautionary note. Ray, I mean, I think just to kind of preempt you there for a second, the unit trust world also, I mean, I think it's interesting to know the one thing to be clear on there is when you buy a share in a company, if that share goes bankrupt, you lose your money. That's what happens as an investor in underlying companies. But if you buy into a unit trust and the unit trust provider goes bankrupt, as an investor, you're fine. And it's an important distinction just to make there, is that, like let's just say the Honest Money Global Equity Fund. It doesn't exist, so please don't look for it. But the Honest Money Global Equity Fund, we get a whole lot of investors, and then Honest Money goes bankrupt. Every investor in a unit trust will be fine, because the company that provides that unit trust is not the owner of the assets. The only owners of assets in a unit trust are the actual unit holders. And the same would apply to an exchange traded fund. The owners of the assets are not the provider of the product, but rather the unit holders or the investors inside. So that's a very important distinction between an exchange traded fund and a unit trust on the one hand, and a direct share on the other. Your risk of blow up is higher on the individual share.
100%. And I think, Warren, spot on, like everything else, do the research before you invest in these kind of investments. The second question was around performance figures and how you should look at them 1 year, 3 year, 5 year, 10 years. And I mean, for me, I personally try my hardest not to open those. I mean, it actually irritates me that I say it irritates me, but I work for these companies. But investment company that you invest with sends you these statements on a quarterly basis, and it actually turns out that it's a regulatory thing. They're actually required to keep you informed in terms of your investments on a quarterly basis, and that's why you get your statements quite regularly. I generally don't open them that regularly. I'm one of those people that invests for long term and would like to see the results over the long term. But in terms of the question, when you're investing in ETFs or unit trusts, particularly the equity unit trusts or stocks on the stock market, you generally do want to invest for longer term, right? So the longer you're invested, you give your money the opportunity to grow within the different cycles of the stock market, because the stock market will go up and will go down. Having said that, should you know what's going on in the short term? I believe so 100%. I think when you invest in something, you want to see that whatever it is that you invested in is doing what it says it does on the tin. So if you're going to invest in in an income fund, and for example, the stock market crashes and all the shares fall, you want to see whether how that income fund reacted to kind of the same, how it was affected by some sort of market crisis compared to an equity fund, for example. Hopefully it didn't respond to that kind of market crisis the same way as an equity fund, which is why I think it's important, although it's not, like I said, although it can give you heart palpitations in the short term, it's always important to have a look at your investments just to understand and make sure that whatever you invested in is doing what you expected it to be doing. And if it's not, to have the conversations either with your financial advisor or with the people who kind of have that who own that investment, or who provide that investment to you.
Yeah, I think, and to me, just to be kind of be a little bit nuts and bolts, if you're going to invest in shares and you're going to invest in the stock market, however you do that, your shortest time frame needs to be at least 5 years. I would feel more comfortable when you're looking at sort of 7 to 10 years as your time frame to invest. But certainly, if you're looking at the stock market with the plan to draw the money out in 2.5 years' time because you want to buy a car, please don't invest in the stock market. It doesn't matter how you do it. That time frame is just far too short. It needs to be at least the 5 years and longer. And maybe just to explain some of the differences there. So Ray talks about an income fund. So typically, in the unit trust world, they have categories of funds, and so if you're looking for something that will give you a bit of interest, and maybe try and do better than deposits at the bank, they'll you can choose a money market unit trust, which is in theory going to be your lowest risk, most secure way of getting some interest. And then one level of risk up from that will be this grouping of funds called income funds, where they might take a little bit more risk than a money market fund. And the hope is that you get a bit more interest, growth over time than a money market fund. But understanding that that little bit of extra interest does come with a bit more potential for the money to go down. Even, it has happened when we saw African Bank hit the wall a couple of years ago, that actually we saw some money market funds and income funds actually losing money. So yes, they're low risk, but they do carry some risk. And don't be surprised if you chasing the highest returns. And then to the question around, do you look at the 1, 3, 6 months or 1 year or 5 years or 10 years? I like Ray's answer. My view is that I don't choose a fund, for example, a unit trust, unless it's been around for a number of years. My minimum in my head, I don't know why, I can't give you scientific evidence, but I kind of want a fund to be around for 3 years as a minimum for me before I become comfortable as an owner of it, unless it's just an index tracker, which is a different story. But But I think track records are important, and timeframes are important for growth assets. So when you're buying something, that's got exposure to shares, understanding how it performs over, 3, 5, 7, 10, 15 years, all of those kinds of timeframes is helpful. What an investment does, especially one that's in the stock market, what it does over a month, to me, is noise. And it's not that valuable. Actually, if you're investing according to performance graphs, possibly your best indicator is the thing that's done the absolute worst over the last 12 months might be the thing to buy, because that might be your best performer over the next 12 months. But if that's the only logic you're applying, then I'm afraid you need to do something very different. But because unfortunately, past performance, they always talk about it. Past performance is no guarantee of future returns. That's a regulatory statement. It's also a cliche, and it's all true. Past performance is never going to guarantee you what your return will look like in the future. And certainly, my own kind of anecdotal evidence is that whatever was number one last year, whatever was the best performing thing last year, almost never is the best performing thing again next year. So just be careful of that. And I think, again, just zoom out your timeframes. Don't worry about 1, 3, 6 months. Those timeframes are simply noise, and it's not going to help you with your long-term financial freedom goals.
Like I said, it is pretty hard when they're sending you your statements on a quarterly basis.
Yeah, absolutely. And I think it's human nature to look at them. And so, in my own life, when I get those, and especially when they're down, the one thing I do is I try and understand if I'm investing in shares, and my shares are down, then I will look at a graph of the whole stock market, because that's the tide. If the tide has gone out, then my ship is going to go down. What I don't want is I don't want it to sink. That's true. But if the whole tide is out, then and my ship's down along with the tide, that's okay. I understand it. Then I try and delete that statement and not worry about it for a little while. Equally, if times are really good and my investment's pumping and and my investment's going up 25 or 30% in a year, before I start to pat myself on the back as the world's greatest investor ever, I'm going to look at the tide again. If the tide is high and it's rising, and the stock market is high, then that tells me the answer. That's the reason my investment is doing well. So graphs and performance, when you give them a context, are more valuable than when you look at them on their own, because you just don't know. The only thing I would say is if your stock market investment is up 30% and the entire stock market is down 30%, be careful. That's not a good sign. Equally, if the entire stock market is up 30% and your stock market investment is down 30%, possibly someone's not doing their job very well. So they, but again, you'll need to do more work than just simply looking at past performance.
Good advice. I like that, Warren. It's exactly what I would do. I think just it's important to understand what you're invested in and how you expect it to perform. But as you said, whether the tide is going out or coming back in.
Ray Mhere from Prescient Investment Management, thank you very much. The time has flown past, and we look forward to kind of answering some more of these questions in the future. I think they're interesting, and I'm certainly learning as we go. And so please send those questions through. We will do our best to answer them. If they're really difficult, we might just pretend that we never received them. That's a joke, but we'll do our best. Ray, thanks so much for joining us.
Thank you, Warren. Thank you for having me.
Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.